Well, with the financial crisis hopefully behind us, investors are taking on a new mindset. In the past, they flocked to the safety of bonds and bond funds as investments, maybe leaving more volatile investments such as stocks alone. But that is changing. Bond prices have risen as interest rates have come down. But are we at a point where investors may not be reaping rewards from that approach? In this morning's U.S. Bank Economic 360, Jeff Krumpelman, U.S. Bank Senior Portfolio Manager, joins us with some insight. Good to have you back, Jeff. Good morning.
Great to be here. Thank you.
Let's start with interest rates. What have they been doing?
Yeah, as you can see, and I appreciate the question because I think it really sets the stage for our discussion this morning, rates have fallen over the last 30 years, so from the early 80s to today, consistently and significantly. And in fact, we're at the 2% yield level on the 10-year U.S. Treasury, which is at the lowest level that we've seen since the aftermath of the Great Depression back in the 1940s. Now, they've fallen more recently over the last 5 years for the reasons that you just cited. The housing bubble and the desire of the Fed to keep rates low to reignite this economy. And the rate decline has been exaggerated by the European debt crisis, which indeed has led investors to flee those international bond markets and come home to the U.S., which is perceived as more safe.
So tie these interest rates in with the bonds and bonds investments.
Yeah, absolutely. And I think this is probably something that we should probably write down, put on a sticky note, and stick it on our refrigerator. The linkage is very easy, simple. When yields fall, the prices of bonds rise. And so that's why bond investors are so happy over the last 10 or 30 years. As the yields have fallen significantly, they've made a lot of money. But on the opposite end, when yields rise, the price of those bonds fall. So at record low levels of interest rates, we probably want to ask ourselves, what happens to the prices of those bonds if yields indeed go up? And we do have some illustrations of that might help our audience to really get perspective on that.
All right, so given this relationship, what do you suggest we keep in mind?
I think a couple things. First, I would say that know the difference between owning an individual bond or a bond fund. They're very different. If you own an individual bond, you don't have that price sensitivity. You don't need to sell the bond. You can continue to own it, collect your interest, and you get your principal back at maturity. If you own a bond fund, on the other hand, there is no set maturity. You own units in or shares of a basket of bonds. You get your interest, but the only way you realize your principal is if you sell that bond fund at some time. So I would say revisit, reacquaint yourself with the strategy and the objective of that particular fund. And those that are shorter in maturity, own bonds that are shorter in maturity, are less sensitive to these price swings.
Well, it's a very timely discussion, and you made it really clear. Jeff Krumpelman, we appreciate you and U.S. Bank.
Thank you.